In Friday's trading session, we saw a very narrow range traded on the S&P 500, finally closing at 6114.63. This is right in this zone here, just above the 6100 strike, where we have approached multiple times over the last month. We've been highlighting the importance of this zone, in particular the large gamma exposure concentrations in and around the 6100 strike. The market looks primed for a breakout of this zone. We see volume in the options market was quite strong on Friday between 6100 and 6200, and the gamma exposure data here highlighted by our purple bars is also concentrated between 6100 and the 6200 strike. The only caveat to that is that we are approaching our upper dealer cluster zone. This is an area where dealer selling pressure in the underlying, in this case it would be S&P futures, but dealer selling pressure in the underlying tends to increase in these zones. And so that's something we want to be aware of if we trade higher up towards this 6150 and 6200 level. That could be met with some slight selling pressure, and so we just want to be aware of that, even though this is a breakout zone. Zooming out just a little bit on our chart, I do want to highlight we are coming to a big decision point. If we go back to the lows in mid-January, January 13th actually, we have this nice uptrend that has formed. It's been tagged 3 different times over the last month. We also have the resistance that I just talked about, just sitting above the 6100 strike. And so this appears to be somewhat of a decision zone, at least technically speaking. My bias is that we will see a breakout to the upside. However, I do leave room in my portfolio to account for the probability of a potential breakdown by adding hedges in this zone here. So in the case that this formation does break down and we see a big shift in gamma exposure, we at least have some hedge protection in our overall portfolio. However, the base case scenario is that this resistance will break to the upside, and that is basically for the reasons that I just highlighted, both volume and gamma exposure concentrated on the upside. So this skew in the options market is basically tipping the scale of probability that we will likely move higher. So that's my thesis going forward. Moving over to our gamma exposure data graph, if we take a look at our GEX weighted volatility gauge, we see that the gauge is sitting at 18.9. This means implied volatility has been lower only 18.9% of the time in the past year. So this is a look back over the last 52 weeks, and implied volatility, which about a month ago was sitting around 80, has moved all the way down to 18.9. Vol sellers have been killing the VIX and selling implied volatility across the mega cap tech, and so that is a reason for the strength we've seen over the last couple of weeks. And when we get into a volatility environment this low, this typically helps foster higher prices. So that combined with the large positive gamma exposure readings that we're seeing, we're well into positive gamma exposure territory. And we can see here on our gamma exposure data graph, on the S&P 500, nearly all the gamma exposure on a net basis at every strike is positive. We have very little negative gamma exposure down here on the left-hand side. And so with that extreme positive gamma exposure, this is a heavy buy the dip environment. So that doesn't mean that dips don't happen, but dips are typically shallow and those typically get bought very quickly. So keep that in mind as we are moving ahead into this OPEX week. I mentioned the vol selling on mega cap tech. Let's take a look at the Qs. The Qs trading at 538.13 after the close on Friday. This 530 level, we mentioned this a number of times over the last couple of weeks. This 530 level was a key level on the Qs. We broke out of that zone on Thursday and have since kept trading higher into Friday, now approaching the 540 strike. And if we look at the gamma exposure concentration, we've got basically between 535 and 550 strong positive gamma exposure with very little negative gamma exposure showing up at all. This is viewing GEX on an absolute basis, and so anything below our blue line here, which is a 0 gamma exposure level, this is negative GEX. And so you can see that clearly on our gamma exposure graph here. It's shown in absolute form. We also saw strong strong volume in the options market between 5:35 and 5:45. This is on Friday's trading session. So again, all of this pointing to a positive skew in the options market, as well as a positive skew in the underlying price trend that we've seen over the last couple of weeks. The 1 weak point for risk on assets has been in the crypto market, with Bitcoin really struggling, staying below the $100,000 level. This is one of our favorite risk on indicators to gauge sentiment in the overall market, especially in risk on assets. However, Bitcoin has not been keeping up. For example, when we look at mega cap tech and the Qs, they're on a whole nother level, especially over the last couple of weeks, with Bitcoin really wallowing here below the 100,000 level. We've been highlighting this zone basically between 90 and 92,000. So that's kind of like the ultimate support zone. We didn't quite get down in there. We've really been focusing between this 96 and 98,000 level. And so there's possibility for another leg lower. You can see our lower dealer cluster zone is right here where this previous gap was. And this is going to be where option dealers are likely going to be buyers for the most part around this 93 to 95,000 zone in here. And so you can see we've already bounced out of that level a couple of times. Looking back over the past month, it looks like the price action on Bitcoin is coming to a decision point as well, similar to what we saw in the S&P 500. Next, let's take a look at Nvidia. We've been tracking Nvidia very closely, and we've been trading Nvidia in our community Discord, which, by the way, you can follow along, link in the description below. Looking at the gamma exposure data, the 140 level is obviously an important strike according to gamma exposure, as well as according to options volume over 200,000 contracts traded on Friday. We are essentially closing the gap here, going back to this DeepSeek AI news in late January. We continue to see volume coming in at these higher strikes. This is outlier volume. These strikes are significantly higher, 10 and 20% higher than where we're trading here. So this is pretty significant. I mean, this is over 100,000 contracts traded at the 150 strike. So it does seem like momentum is back in Nvidia. Speculators are coming back in at these higher strikes. And so that's something that we're going to continue to play for, especially after we see some consolidation around this 140 level. I think that's probably the most likely stopping point here this OPEX week, right in this dealer cluster zone. That's our target ultimately in our current position, is the 140 strike. So we're nearly there as of Friday's trading session. So I'd like to see some consolidation around the 140 strike, maybe even a slight pullback continuing on in this trend. I'd love to re-enter for a third trade in the last couple of weeks, potentially targeting this 150 strike. And this would obviously line up for previous highs that we've seen over the last 6 weeks. Turning next to Meta, the strength of Meta is just fantastic. I mean, basically since this sort of low here on January 13th, it's just been on a tear, basically going from below 600 to now approaching the 750 strike. We've been looking at the 700 and 750 strikes on Meta for the past month, and it basically blew through the 700 strike with just a little consolidation, barely giving anyone a chance to get in. I'm looking for another consolidation around the 750 strike. We're already seeing gamma exposure and volume coming in at the 800 strike. So ultimately, what I'd love to see is a tag of this 750 strike, a slight rejection maybe back into the lower 720s, and then playing for a move back up to 750 and potentially into the 775 or 800 range for the March and April expirations. Next, let's take a look at Apple. This is another name we've been trading in our community Discord, in our portfolio. We actually had a pretty bad entry here around the 240 strike, with Apple selling off in the early part of February, but it has since come back right back up to these large positive gamma exposure concentrations. Our ultimate target has been the 255, somewhere between 250 and 255 strike. Those are the largest gamma exposure concentrations. And so really happy to see that it's come all the way back, and I think it's got some more juice to get it up into this 250 to 255 zone here in the coming weeks. We also see volume strong in the Apple options market, nearly 100,000 contracts traded at that 250 strike on Friday. And remember, you can get access to all of our premium features, our gamma exposure dashboard, and our option flow analytics tools by by heading over to geeksoffinance.com. We are running a special $300 off your yearly portfolio manager tier subscription. Use code WINTER2025 at checkout. We do have a few spots remaining, so take advantage of that while you can. I'll put a link down in the description below. Members also get access to our community Discord. We've got a ton of great traders in there sharing their own trading strategies and trade setups. We also share our own portfolio strategy as well as our trade setups as well. So a ton of great information in there and education. You definitely don't want to miss that. Link in the description below. Thanks so much everybody for watching, and we'll see you guys in the next video.